Welcome to the NAFA webinar series, providing you with timely information and training each month on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today, we are presenting advanced strategies to increase Social Security income. With me today is Brandon Buckingham. Brandon Buckingham is the National Director for the Advanced Planning Group for Prudential Annuities. He and his team of tax attorneys, certified financial planners, and retirement specialists provide technical, marketing, and sales support for all matters concerning variable annuities, qualified retirement plans, estate, gift, and income tax planning, and other advanced market topics. Mr. Buckingham is a frequent speaker and published author on subjects including IRAs, qualified retirement plans, annuities, and estate and income tax planning with retirement assets. His articles have been published in the National Underwriter, Annuity Selling Guide, Life and Health Advisor, National Association of Variable Annuities Outlook, Boomer Market Advisor Magazine, Investment News, and Trust and Estates Magazine. During today's webinar, Brandon will provide you with advanced and innovative strategies to help clients increase their Social Security benefits. The webinar will address the current state of the Social Security system and options for improving the Social Security Trust Fund, advanced planning strategies to increase Social Security income, including file and suspend and restricted application, events that could reduce Social Security benefits, and the importance of creating guaranteed income as part of a retirement income plan. We encourage you to type your questions on the question box on the right side of your screen at any time during the presentation. Questions will be answered at the end of the presentation. So let's begin. Brandon, welcome to the webinar.
Well, thank you. And Brandon, thank you very much for this opportunity to speak here today, and thank you everybody for taking time to join us. I want to spend about 30 minutes before we open up the Q&A and walk you through this presentation, and I'm going to give you some ideas, some actual ideas to help your clients, but also help you in your business. And of course, we're going to be talking about Social Security. And usually when I present this topic in front of a live audience, I'll ask the audience this question. How many people here consider themselves very knowledgeable about Social Security? And typically I'll get a few hands. Then I'll ask this question. How many of your clients will eventually have to make a decision about Social Security? And the answer is everybody, right? And I think to be imaged as the retirement income advisor of choice, you really need to know and understand all things retirement income planning, including Social Security, and how do you incorporate Social Security into a larger comprehensive retirement income plan. Now, when I do client events, I'll ask the clients this question. If you had $1 million, would you look at that account from time to time and incorporate that account into your comprehensive retirement income plan? And the answer probably is yes, right? And that's exactly what Social Security could be if you make the right decisions with Social Security. If you make the wrong decisions, it could be a whole lot less. So what we're going to talk about here today, as Brendan mentioned, we'll talk a little bit about the health and the future of the Social Security system. I'll spend most of the time really talking about strategies to help your clients maximize their benefits under the current system, and then we'll talk about what I consider to be the Social Security cash flow. So let's start right into the basics here. How is the system funded? Well, the system is funded through payroll tax, right? We each pay a payroll tax of 6.2% up to our taxable wage base, which this year is $118,500. The employee pays 6.2%, and the employer also pays 6.2% up to that taxable wage base. Now, you become entitled to benefits or become eligible for benefits as soon as you have 40 quarters of earnings. Now, that's 10 years. Now, they don't have to be consecutive. You are credited with a quarter once you have earnings of $1,220. So once you have earnings in a given year of $4,880, even if you have all those earnings in 1 week, you will be credited with 4 quarters. Now, you can only get 4 quarters in a given year, and once you have 40 quarters, you will be entitled to Social Security benefits. Now, your benefits will be calculated based on your highest 35 years of earnings. Now, that's important because if you don't have 35 years of earnings, then you have some zeros added to that calculation, which of course could have a downward pressure on your benefit base. So the example I like to use here is my wife. My wife is a high school teacher. She left the workforce for 12 years after my daughter was born, and it's not likely when she retires that she's going to have 35 years of earnings, in which case she'll have some zeros added to her calculation, which could and will reduce her benefit. Okay, but once you have 40 quarters of earnings, you're entitled to Social Security. So let's talk about the health of the system. There's $2.6 trillion in the Social Security Trust Fund. Well, is it really a Social Security Trust Fund? I mean, it's purely accounting, right? You know, Social Security was created in 1935. And in 1935, you were entitled to Social Security benefits once you reached your full retirement age of age 65. So back in 1935, once you reached age 65, you were entitled to your full benefits. Okay, what was the life expectancy back in 1935? It was actually 60 years old. 60 years old. Now, that included infant mortality. If you lived past your birth, the average American in 1935 will live to 65 years and 8 months. So the average American would receive 8 months of Social Security benefits back in 1935. So the system was pretty healthy. In 1950, you had 15 people paying into the system for every one person receiving benefits. So you had 15 workers supporting each retiree. Now you have less than 2 paying into the system for every one person receiving benefits, and that's about to switch, and very soon you have more people drawing from Social Security than paying into it. And according to the Social Security Administration, if we see no changes to the current system, by 2033, the trust fund will be depleted. We'll only be able to pay 77% of those promised benefits. Matter of fact, you'll see that statement on the front page of the Social Security statement. Do you remember those statements we used to receive every year around our birthday? Now we'll receive it every 5th year. You can always go online, though, to socialsecurity.gov, type in your Social Security information, and it'll pull up an online statement, and you'll see in the front page of that statement, it'll say very clearly, if we don't see any changes to the current system by 2033, we'll only be able to pay about 77% of those promised benefits. So my question to you is, do you think we'll see some changes? And I think, well, first of all, my question, do you think Social Security is going away? And most people answer no, it's not going to go away, but we'll probably see some changes, and I think we will as well. And certainly you're beginning to see the debate now, both from the Republicans and the Democrats, on potential changes. So let's talk about some of those potential changes we could see to help secure Social Security. One proposal is to increase the payroll tax. So I mentioned before, we each pay a payroll tax of 6.2%, the employee and the employer. What if we raise that payroll tax by 1%, so a 0.5% increase for both the employee and the employer, so from 6.2% to 6.7%. If we did that, that alone would extend the life of the Social Security Trust Fund to 2056. What if we increase the payroll tax by a total of 2%, so a 1% increase for the employee and the employer, so a 7.2% payroll tax for each? That would extend the life of the trust fund to 2083. What if we uncap the earnings? So I mentioned before, the Social Security payroll tax applies to up to your taxable wage base, which this year is $118,500. Income above that is not subject to that tax. What if we uncapped it? Kind of like what we do for the Medicare payroll tax. That would extend the life of the trust fund to 2083. What else? Maybe raising the full retirement age. This is likely to happen. Right now, the full retirement age is age 66 to 67, depending on when you were born. What if we raise that to 68 or 70? Well, that in and of itself would do very little to extend the life of the trust fund. Because by the time I turn age 70, if we see no other changes, there'll be nothing left in the trust fund. But I do think that will be part of some of the changes we're likely to see. I would not be surprised if we did not see an increase in the full retirement age for those born before, let's say, 1965. What else? There's some proposals to make it means tested. So the more money you make, your benefits will be reduced. There is a proposal by Jeb Bush, I think it was just announced today, that perhaps we reduce the benefits if you take it early. So there is a reduction in benefits if you take benefits before your full retirement age. We'll talk about that shortly. There's a proposal to even further reduce that more. There is a proposal that we would adjust the inflation rates we use to adjust Social Security benefits. Maybe we go to a chained CPI as opposed to a regular CPI. There's a proposal or a discussion that we base benefits not on the highest 35 years of earnings, but on the highest 40 years of earnings. And the rationale for doing that is, well, if you base on the highest 40 years of earnings, and if you don't have 40 years of earnings, well, you're going to have some zeros, or it also calculates some of your earlier working years where your earnings were a lot less, and that, of course, could have some downward pressure on your benefits. So those are just some of the things that are being discussed today. I don't think Social Security is going to go away. I think we'll see some changes. But this is a conversation you should have with your clients to help them prepare realistically how much they could depend on Social Security in the future. Okay, so the first question your clients have to ask themselves, and hopefully they'll be talking to you about this first, is when do I take benefits? And you can take your benefits at your full retirement age, and again, that's age 66 to 67, depending on when you were born. And once you hit your full retirement age, you're entitled to 100% of your scheduled benefits. Now, you can take benefits early, and if you take it as early as age 62, but if you take benefits early, that could be a reduction in benefits, and that's a lifetime reduction, by the way. And that means your benefits could be reduced as much as 25 or 30%, depending on when you take those benefits. And by the way, that's a reduced benefit for the rest of your life and potentially a reduced benefit for your spouse. Now, if you take benefits past your full retirement age, you get deferral credits. It's an 8% deferral credit, which means you'll get 8% more each year you wait. If you wait till age 70, you can receive 30% higher benefit for the rest of your life. And by the way, that can be an increased benefit for your spouse's life as well. Okay, so knowing that if you take benefits before your full retirement age, those benefits will be reduced. What do you think the percentage of Americans who take benefits early? 74% of Americans will take Social Security benefits before their full retirement age, resulting in a reduced benefit over their lifetime and the life of their spouse. 50%, nearly 50%, will take Social Security benefits as soon as they can at age 62, resulting in the biggest reduction of lifetime benefits. Now, why do you think that is? Why do you think people take benefits early? Well, there could be various reasons. One is maybe they did not save enough for retirement. They're forced into early retirement. They had no other choice but to tap into Social Security to live. That's my father-in-law. My father-in-law was forced into early retirement. He did not have a financial advisor. Apparently, he did not save enough for retirement on his own. He had no choice but to elect Social Security benefits early. And of course, you can't argue with that. Health issues. Maybe they're not long for this world, right? They got longevity issues. So for them, it doesn't make sense to wait to take benefits because of their health issues. You hear this one, I don't trust the government, right? Bird in the hand, I'm going to take the money and run. Well, I'm going to take the money early and invest it. Well, most people take the money early and spend it, right? Now, there used to be a strategy where you could take benefits early, invest it, and then when you turn age 70, pay it back. You keep your earnings in your pocket. Now, they got rid of that some years ago. you could pay those benefits back so long as you pay it back within 12 months. And that's an important note there, because if you talk to your client says, hey, we just started taking Social Security benefits 6 months ago, well, ask them and make sure that was the right thing to do. If it wasn't, they may want to consider paying that money back, and then they'll start getting those deferral credits as if they never took the benefits in the first place. I think the real reason, however, people take benefits early is they simply don't know they have other options and strategies with respect to their benefit. They haven't talked to you first. They have not incorporated Social Security into their larger retirement income plan. And this is why I think it's so important that clients talk to their financial advisors first before they make such an important decision. So I mentioned, by the way, 74% of Americans take benefits early. What do you think the percentage of men who take benefits early? 90%. 90% of men take benefits early. And I think most people would agree women tend to live longer than men. So the fact that so many men take benefits early, that could adversely affect what's left to the surviving spouse. So again, the decision you make or your clients make with Social Security affects not just them, but potentially their spouse. Okay, one of the questions I get often is, okay, what if I'm still working? Well, if you take benefits early and you are still working, then those benefits will be reduced because you took it early, but it'll also be further reduced by $1 for every $2 over $15,000. So, for instance, if I take benefits early, before my full retirement age, and I'm making $25,000 in my job, my Social Security benefits will be reduced by about $5,000. In the year I reach my full retirement age, my benefits will be reduced, but not as much. It'll be reduced by $1 for every $3 over a higher threshold of $41,000. And if I'm working after my full retirement age, my benefits aren't reduced at all. Now, another question I get is, okay, what's the break-even point? How long do I have to live before I start receiving more from Social Security by waiting to take those benefits? And the answer is, well, if I take benefits at age 66, assuming that's my full retirement age, as opposed to age 62, as long as I live past age 76, I'm going to receive more from Social Security by waiting those 4 years, and every year I live past age 76, the more I'll receive. If I take benefits at age 70, as opposed to age 62, the break-even year is age 79. And if I take benefits at age 70 as opposed to 66, the break-even year is age 81. So part of that conversation you should have with the client is, well, how long do you think you're going to live? You know, if you think you live past age 76 or 79 or 81, it may make sense for you to wait to take benefits, and because every year you live past that, you'll receive more and more. You know, a lot of people, I think, underestimate their longevity. You have a married couple, age 65, a healthy 65-year-old couple, there's nearly a 50% chance that one of the two will live to age 92. So that should be part of the conversation you have with your client. Of course, by waiting to take benefits, they may have to bridge that income gap through other means. So, you know, keep that in mind. Okay, so we talked about benefits, you know, how I incur my benefits. Now, my spouse is also entitled to benefits. And my spouse is entitled to spousal benefits, and her benefit will be based on her earnings record or up to half of mine, the greater of the two. So once she reaches her full retirement age, she can file for spousal benefits, and that could be up to half of my benefits if it's more than her own benefit based on her own earnings record. One caveat here, she cannot file for spousal benefits until I actually file for my own benefits. There's an exception to that rule, and that is based for divorced spouses. Because if I had to wait for my ex-spouse to file for benefits before I'm entitled to my own spousal benefit, she'll never file for benefits, right? So that's the one exception. You do not have to wait for ex-spouses to file for their own benefit for you to be entitled to a spousal benefit. So using my wife as an example, let's assume I file for my benefits, and then at her full retirement age, she can file for a spousal benefit. If half of my benefit is more than her own benefit, then she'll receive the greater of the two. And I mentioned before, my wife was a high school teacher, left the workforce for a number of years, so it is likely that half of my benefit will be higher than her benefit based on her earnings record. What if she filed for spousal benefits before her full retirement age? She can do that. She can do it as early as age 62, so long as I file for my own benefits. But instead of receiving 50% of my benefits, she'll receive 35% of my benefits. And then there's survivor benefits. So when I die, my wife will receive a survivor benefit, and the benefit she'll receive will be based on when I file for my own benefit. As I mentioned before, my benefit will be calculated among many things, but also among determine when I file for benefits. So if I take benefits early, that's a reduced payout for my life, but also a reduced survivor benefit for my surviving spouse. If I take benefits later, then that could be an enhanced payment, not just to me, but an enhanced survivor benefit to my spouse. Now, my wife can receive my full benefit as a survivor benefit when she files for it, so long as she files for it at her full retirement age or later. She could file for a survivor benefit as early as age 60. In that case, she won't receive 100% of the benefit I was receiving before I died. There will be a reduction up to 28.5%. Okay. Let me walk you through an example on survivor benefits. And I think this is an important conversation to have with those clients of yours that are recently widowed, because I think a lot of people don't realize there are a lot of options with respect to the survivor benefits under the Social Security system. So the example I'll use here is we have Wendy, age 60. Her husband passed away when he was age 66, and in the year he passed away, let's assume his full benefit was $2,400. Now Wendy, she had her own Social Security benefit based on her own earnings record. So let's assume at her full retirement age of 66, her benefit based on her earnings record was $2,000 a month. If she takes her benefit early at age 62, there'll be a reduction there, so it'll be $1,500 instead. And if she waited to age 70, her benefit would be based on her earnings record would be $2,640. Now, she's also entitled to a survivor benefit. She can receive a survivor benefit as early as age 60. In that case, she'll receive $1,716. If she waits to her full retirement age, she'll receive her full survivor benefit, the $2,400 her husband was receiving before he died. Okay, so let me walk you through her options. Option number one, age 60, she says, hey, I'm going to take my survivor benefit immediately, which means she'll receive her husband's benefit, but reduced by 28.5%, so she'll receive $1,716 a month. Option two is she'll wait till age 62, and then she'll tap into her own benefit based on her own earnings record, and then at age 66, she'll switch to the survivor benefit, and now she'll receive the $2,400 a month her husband was receiving before he died. And then there's option three, in which case she takes the survivor benefit early at age 60, that's the earliest as you can take it, and then she leaves her benefit alone. And then when she turns age 70, she switches to her benefit based on her earnings record. So let's do a quick comparison. If she took the survivor benefit early and only the survivor benefit over her lifetime, she's going to receive $659,000. If she took her benefit at age 62 and then at her full retirement age switched to the survivor benefit, she'll receive $748,000. And if she took the survivor benefit early at age 60 and let her benefit defer until age 70 and then switch to her benefit at age 70 over her lifetime, she'll receive nearly $900,000. That's a big difference. That's almost $250,000 more by taking advantage of the different options here. But first of all, I think a lot of widows don't fully understand their different options. Okay. Now, I want to talk about another strategy called file and suspend. File and suspend, I think many people are familiar with this strategy. This strategy works very well when you have spouses with different benefits, right? So you have maybe one spouse that has a much larger benefit compared to the other spouse. So I'm going to use an example here. I think that's the best way to explain file and suspend. Let's assume Jen and Matt married and both 62 years old. Let's assume Matt's full benefit when he reaches his full retirement age at 66 will be $2,000 a month. Let's assume Jen stayed at home and she had no earnings record. So let's keep it very simple. We'll assume Matt lives to age 85. We'll assume Jen lives to age 92. Again, there's a 50% chance of one of the two spouses will live to age 92. So we'll have Jen living till age 92. Okay, option one. When Matt turns age 62, he files for benefits. Again, half the Americans do just this. So instead of him receiving his full benefit of $2,000 a month, he'll receive $1,500 a month. And because he filed for his benefit, Jen can file for spousal benefit. But she's filing for spousal benefit before she reaches her full retirement age, so she's not going to receive 50% of Matt's full benefit. She'll receive 35%. 35% of his full benefit of $2,000 gives her a spousal benefit of $700 a month. This is what half the Americans do. Option two, Matt says, I'll wait till my full retirement age. And by waiting till his full retirement age, he'll receive his full benefit of $2,000 a month. And because he filed for his benefit, Jen can file for spousal benefit. And since she's filing for that spousal benefit at her full retirement age, she'll now receive 50% of his benefit. So he'll receive a check for $2,000. She'll receive a spousal check for $1,000. And then when Matt dies, her survivor benefit will be the $2,000 that Matt was receiving before he died. And then there's option three, and this is called file and suspend. Let's assume Matt says, hey, you know what? I don't want to touch my benefits. I'm going to wait till age 70. Because if I wait till age 70, my benefits will be enhanced. Instead of receiving $2,000 a month, I'll receive $2,640 a month. However, Jen can't file for spousal benefits until Matt files for benefits himself. So what he could do at age 66 is file for benefits and then suspend those benefits. And by suspending those benefits, he'll get those 8% deferral credits, which means at age 70 he'll receive an enhanced payout. But because he filed, Jen can now file for a spousal benefit. So Jen will file for a spousal benefit, receive $1,000 a month, so half of his full benefit. And then when Matt dies, Jen will receive a survivor benefit of $2,640, the enhanced benefit. That is called file and suspend. Now, there has been some talk about getting rid of this strategy. We'll see. A lot of people don't take advantage of the strategy. I mentioned 74% of Americans take benefits early. What do you think the percentage of Americans who take benefits as late as they can at age 70? It's only 4%. Only 4%. And certainly a lot less will actually do the file and suspend. So it's not highly utilized, but there is some discussion about getting rid of it. Okay, that's great. File and suspend works very well when you have, let's recap here real quick. So if Matt and Jen took benefits at age 62, which is what most people do over their joint life, they'll receive $745,000 in Social Security. If they waited to their full retirement age, they'll receive $852,000 over their joint lives. And if they took advantage of this little-known strategy called file and suspend, they'll receive $924,000 from the system. Again, this strategy works very well when you have one spouse with a much larger Social Security benefit than the other spouse. What about where you have two spouses with similar or near equal benefits? Well, there's another strategy called restricted application. And again, the best way to explain this is through an example. Let's assume Adam and Megan are married and they're both age 66. So they're both at their full retirement age. Megan says, hey, at age 66, I'm going to retire. I'll receive my full benefit of $1,500 a month based on her earnings record. Adam says, hey, I can take my benefit at age 66. It'll be $2,000. But if I wait till age 70, it'll be $2,640. So I'm going to wait till age 70. Okay, so option number one, Megan, age 66, she taps into her benefit, $1,500 a month. Adam says, I'm not going to take benefits till age 70, in which case he'll receive $2,640 a month. Let's assume Adam predeceases Megan. Now Megan's survivor benefit will be the $2,640 that Adam was receiving before he died. Did they leave money on the table? They did, right? Because what Adam could have done is Adam could file a restricted application. So Megan files for her benefits at age 66. Adam says, I'm not going to touch my benefits till age 70, but when he's age 66, he could file a restricted application whereby he'll receive spousal benefits based on Megan's benefit. So at age 66, he can receive half of Megan's benefit. Her monthly benefit was $1,500 a month, so his spousal benefit will be $750 a month, $9,000 a year for 4 years. You know, that's $36,000 most people will just simply leave on the table. And then, of course, when he reaches age 70, he'll receive his higher benefit. So that's called a restricted application. That works very well when you have spouses with close and near equal benefits. And again, there are a lot of different variables. You may want to use an online calculator to plug in the specific information for your clients, including their earnings, benefits, and their ages, and so forth. Okay, so that kind of brings me to something I refer to as the Social Security cash flow. So the first thing you may want to consider doing when speaking to your clients about their options is, get a copy of their Social Security statement. Find out what their estimated benefits are, and it'll give you those estimated benefits depending on whether they take it at their full retirement age, they take it early, or take it later. I think that's a good starting point, but then keep in mind those benefits could be reduced by two other things: taxes and Medicare premiums. Now, they could be reduced if they take benefits early. They could be reduced if we see those changes to the Social Security system, but they will be reduced by taxes and Medicare premiums. So let's talk about taxes first. Now, there used to be a time when Social Security benefits was tax-free. Remember that? Until the 1980s. And in the 1980s, Tip O'Neill and Ronald Reagan got together. Back then, Democrats and Republicans tended to work together. And they put together something called the Greenspan Commission, where they made some changes to help shore up Social Security. One of the things they changed was making Social Security benefits subject to an income tax depending on your provisional income. Now, the provisional income, so a married couple with provisional income of less than $32,000, those Social Security benefits would be completely tax-free. If your provisional income is over $44,000, then up to 85% of your Social Security benefits could be subject to an income tax. Okay, so what's provisional income for purposes of this tax? Provisional income includes half the benefits you receive from Social Security. It includes all your earned income, all your investment income, including income from muni bonds. It does not include tax-deferred buildup in IRAs, 401k plans, annuities. Does not include income from life insurance proceeds. It does not include income from Roth IRAs. Now, that's an important point there, because if I retired, and let's assume I had no earnings, and let's assume the only income I had was withdrawals from my 401k plan. I'm sorry, from my Roth IRA. Let's assume I drew $200,000 from my Roth IRA, and that's the only income I had. Well, those distributions would be tax-free, but also that means my Social Security benefits would be tax-free. And that really kind of highlights the importance of tax diversification, right? The importance of having different buckets: a taxable bucket, a tax-deferred bucket, and a tax-free bucket. It'll put you in a much better position to manage your tax liability, but also potentially reduce the taxation on your Social Security benefits. And then second, your Social Security check will be reduced by your Part B Medicare premiums. Once you enroll in Social Security, you're automatically enrolled in Medicare. And Part B, those premiums are taken out of your Social Security check. A lot of people don't realize that. And those premiums can be anywhere from $104 a month to $335 a month, depending on your adjusted gross income. So let's go back to the example. Matt and Jen, they did the file and suspend strategy, where he received $2,640 based on his benefit. She received a spousal benefit of $1,000. So between the two, they received monthly $3,640 a month. Once you factor in taxes and Part B Medicare premiums, they're going to reasonably expect to receive about $900 less. And keep in mind, they may receive even less if we don't see some changes to Social Security. I think this brings up an opportunity for you to really talk to your clients about the importance of incorporating Social Security into your larger retirement income plan, but the importance of supplementing Social Security with other sources of guaranteed income. I think 30 years ago, most people could safely rely on Social Security and pension income to provide the income they need in retirement, and few probably had to rely on their own personal savings. I think if you look at that as a pyramid, that pyramid is now inverted, where fewer and fewer people can rely on pensions and a Social Security for the income they need in retirement, and more will have to rely on their own personal savings. I think most people would agree with that general premise. Let me put some numbers around that. 1983, what do you think the percentage of household wealth in retirement accounts? What was the percentage of household wealth in retirement accounts on average? And the answer I usually get is 15%, 10%, 5%. It's actually 1%. 1%. Back in 1983, the average household wealth, 1% of the household wealth were in retirement accounts. And that makes sense, right? Because most people could rely on Social Security and a pension. Many people didn't have to rely on their own personal savings for the retirement income needs. Fast forward to 2013, well, and these numbers are a little dated, but it holds true still in 2015. But in 2013, assuming you had $100,000 of investable assets, on average, 42% of household wealth were invested in retirement accounts, 401ks, IRAs, and the like. And I think that's a testament to the hard work our industry has done to make sure our clients had saved enough for retirement. Having those conversations with your clients, are you saving enough? How much should you be saving? Having those what's your number type of conversations. However, when you have 10,000 baby boomers turning age 65 every year and will so for the next 20 years, I think that conversation needs to change a little bit. I think the focus needs to be less on the cash pile and more on the cash flow. And what are some of the things that your clients can do to help create additional sources of guaranteed, sustainable, potentially increasing income? Certainly, there's several solutions there, and annuity could be one of them. I covered a lot here in the last 37 minutes. I know there's going to be some questions. I do want to just make sure everyone here knows that you'll be receiving an email from Brendan with a couple attachments, one of which would be a white paper that talks about some of these strategies. I do believe, and Brendan can correct me if I'm wrong, I do believe there's a recording of this webinar and that these slides will be available online. So Brendan, at this time, I'm sure there are some questions that were written in, and if there are, I'd be more than happy to entertain those questions.
Brandon, thank you. We have many questions, so we'll try to get to them all. First of all, I want to address the most common question pertinent to what Brandon was just discussing. Yes, this webinar is being recorded. A web link that will allow you to watch the webinar as often as you want. Both audio and video will be made available to you by email. And in addition, you'll be receiving 2 documents by email, one of which is a brochure and the other one is a white paper pertinent to this presentation. The actual PowerPoint slides will not be sent out, but the link to the recorded webinar with slides will be. All right, so we'll go ahead and move on to our next question. Do the survivor benefits apply to the ex-spouse if the 2 spouses were married for 10 or more years?
Great question. The answer is yes. So long as you're married for at least 10 years and currently divorced, you're entitled to spousal benefit and a survivor benefit. Now, you may be entitled for a survivor benefit if you are remarried, so long as you remarried after age, I believe it's 65. So as long as you're married for at least 10 years, you can be entitled to survivor benefits.
Our next question, how does someone go about finding out their divorced spouse's benefit they're eligible for?
That's a really tough question, and it's not always easy. If you have your ex-spouse's Social Security number, you go down to the Social Security Administration, they should be able to determine his or her benefits on your behalf. If you don't have your ex-spouse's Social Security number, there could be other ways. Obviously, it'll be a little bit harder for the system, the administration, to track that.
The next question, how much in IOUs does the U.S. government owe the Social Security Administration?
Yeah, I really don't know. Right now it's estimated at $2.6 trillion, and that comes from the CB, the Congressional Budget Office. The interesting question is, what's that going to look like in the next 2, 3, 5, 10, 15 years if we don't see some changes to the system? And those IOUs can definitely increase. So I think you begin to see some of the discussion, whether you'll find agreement, that's another thing, but you're definitely seeing some of the discussion in D.C. about making some changes to decrease the IOUs.
And our next question is regarding break-even points. Is time value of money taken into consideration when calculating a live-to age?
Great question. So in the example I showed you the break-even points, that did not include time value of money. So certainly that's got to be a conversation is, hey, what if we take this money early and invest it? What will it look like then? That could definitely change the output. Now, most people take the Social Security benefits and don't invest it, they spend it. But that's definitely a consideration and something that is worth having a conversation with your client.
Okay, we have a comment question. If your spouse files for a spousal benefit prior to their FRA, they will deem to file for their reduced benefits off of their own record and lose their ability to let their own benefits defer over time.
Great point, and that's very important because if I file as a spousal benefit early, I'm locked into that early amount, that reduced amount. I can't later say, hey, when I turn age 66 or whatever my full retirement age, I would like to switch to my benefit because it will be higher then. Once you take a spousal benefit, you take it early, whatever that dollar amount is, you're locked into that. You can't change that. Great point.
The next question, in the divorce scenario, because the spouse is not required to file for the other to receive benefits, is there an age that has to be achieved that allows the spouse to file on their record? If so, what is or are the ages?
Good question. The spousal benefit, the ex-spouse here, has to be at least age 62, in which case they'll receive a spousal benefit. They're not going to receive 50%, but they'll receive 35% of their ex-spouse's full benefit. An interesting point about the divorced spouse as well. You could pick the ex, if you're married several times, let's assume I was married first time for love, that lasted 10 years. Then I married for money, well that lasted 10 years. I can pick the ex-spouse that provides me the greater spousal benefit. And of course, if I have several ex-spouses, they can all file for benefits based on my earnings record, including my current spouse. So again, you wonder why the system is going broke.
What happens if the spouse is 68 years old and was waiting to file until age 70 and dies before taking the benefit? What benefit does the survivor get?
The survivor benefit will be based as if he filed for benefit the day before he died. So age 68 in that example.
Would there be any reason to wait on the survivor benefit until age 66 and then her retirement at 70? Where would the numbers fall on this?
So that was kind of the example I used on the survivor benefit option. So there may make sense to wait till your full retirement age to receive the full survivor benefit, and then at age 70 switch to your benefit, which you will then allow your benefits to increase, assuming that's going to be more. And again, you have to run the numbers. There's several different options with respect to survivor benefits, but it does become a bit of a numbers game. There's some great online calculators out there. There's some great free ones, by the way. Not that I can endorse any of them, but I've known some advisors to like them. I know T. Rowe Price has one, BlackRock has one. I know there's a couple paid-for services out there that will give you some comprehensive calculators and then some output and summary to help you have that conversation with your clients about their various options.
The next question, under file and suspend, if the spouse is younger, age 62, and the primary breadwinner is FRA, age 66, is the benefit reduced for the spouse since they are only 62?
Yeah, so This is from the one with the larger benefit, filed at age 66, full retirement age. The spouse could file for spousal benefit. If she waits till her full retirement age, she'll receive 50% of his benefit. If she files early at age 62, she'll receive 35% of his benefit. So there will be a reduction in the spousal benefit if the spouse files before his or her full retirement age.
Can husband and wife both file and suspend their benefits and then collect spousal benefits from each other's full retirement age benefits?
Great question. I like how you're thinking. The answer is no. You can't both do file and suspend and elect to receive benefits from each other.
And the next question, if both spouses are at full retirement age, husband is collecting at his full rate of normal retirement age, he is not employed, wife is working and earning $100,000 a year and is continuing to work, are there any problems with the wife collecting a spousal benefit until her age 70?
Good question. So if she files for a spousal benefit based on her husband who is retired, she's still working, her spousal benefit, well, no, her spousal benefit would not be reduced because she's over her full retirement age. But let me revise the question a little bit because I think this is where the participant was trying to get at. What if the working spouse wants to receive spousal benefit prior to her full retirement age, or her husband retired, she's still working? She can file for spousal benefit, but then her spousal benefit will be further reduced by $1 for every $2 over that threshold of $15,000. If she's over her full retirement age, she can file for spousal benefit, still work, and those benefits will not be reduced.
Are Roth distributions counted in income to calculate the Medicare Part B surcharge?
A Roth IRA, no. So they're referring to the 3.8% surcharge, the surtax on investment income for those who make over $200,000 single filer, $250,000 joint filer. Roth IRA is not subject to an income tax. It's not subject to that Medicare surtax. Again, that was part of the Affordable Care Act that was passed a couple of years ago. So again, Roth IRAs, I think, is an important conversation to have with your clients because it will help them reduce their tax liability, avoid those additional surtaxes, and potentially reduce the taxation on their Social Security benefits. By the way, you could also reduce your Part B premiums, right? Because that is based on your income earned 2 years ago. Roth IRA is not part of that calculation. So again, tax diversification, I think, becomes much more important, not just this changing and rising tax environment, but also of ways to reduce your healthcare costs, your Social Security taxation, as well as your income tax, and again, that surtax.
And we have a helpful comment from one of our participants. Brandon, hopefully we're not getting into controversy here. I'll let you judge that. FYI, you must be age 60, not 65 or over, before you remarry in order to qualify for survivor benefits.
Did I say 65? He's right. It's 60.
All right. Excellent. And the next question, we have so many. If an ex-spouse moves out of the country but earned enough quarters to qualify for Social Security, can the spouse file for spousal benefits?
This is getting a little bit over my head because there are different treaties with different countries with respect to Social Security benefits, so I'm unfortunately have to take a punt on that question.
Okay. How many different combinations are there for married couples?
How many different combinations? I'm not sure if I fully understand the question, but
sure. In terms of Social Security retirement options, how many different combinations of choices are there?
Well, there's a lot of different variables, and it's going to change depending on the spread and the ages, and each spouse's earnings record, and when one spouse files for his or her benefits, and one files for the spousal benefit, and whether they do a strategy like file and suspend or restricted application. There's even a strategy where you can do both file and suspend and restricted application. So I don't have any answer to that, but obviously the options could be hundreds if not thousands.
And the next question, can you spend some time discussing WEP? For example, if husband is under the WEP, can he take the full Social Security benefit at NRA and receive it all if he is not collecting his public pension?
Yeah, and I'm not going to go into too much detail on that because there's a lot of variables in this. Obviously, the question is relating to what's called the windfall provision. And with the windfall provision, if one is receiving benefits from, let's say, a company that has never paid into the Social Security system, there's going to be, and then you work for a company that does pay in Social Security, there's going to be an offset and a reduction in those benefits.
Okay. Does Prudential have a client presentation we can use to present this information?
Prudential does have a client presentation. It's a little bit more high level than some of the subject matter we talked about here today, but it does talk about some of the basic strategies of like file and suspend, restricted application, and what happens if you take benefits at different ages. But we do have one available. You have to reach out to a representative from Prudential. I don't have that number in front of me, but certainly that's something we can follow up with you.
So any Prudential reps on the call certainly could go ahead and take advantage of that. Excellent.
Absolutely.
Okay. Please review and contrast spousal benefits versus restricted versus file and suspend.
So file and suspend works well when you have one spouse which has a much higher earnings record than the other, therefore would have a higher Social Security benefit based on their earnings record. In that case, the spouse with a higher benefit could file for benefits at his or her full retirement age and then suspend them. And by suspending it, they'll get that 8% deferral credit, and then when that person reaches age 70, they can start receiving a higher payment, but because they filed early, now the spouse could start receiving spousal benefits. Restricted application works well when you have spouses who are with similar earnings record or similar benefit base, and that works well when both spouses are at their full retirement age. One spouse says, hey, I'm not going to take benefits till I later turn age 70. The other spouse, hey, I'm going to take benefits now. And then the benefit that the spouse that defers their benefit could file a restricted application, thereby getting the spousal benefit until for several years until they switch to their own benefit.
We have such a very attentive group continuing to stay on the webinar through the Q&A, which is outstanding. So I think we're going to go ahead and push on because we have a lot more questions in the 7 minutes left. Let's see here. We have, I have often heard that the government does not invest Social Security funds well. How are Social Security funds invested by the government?
They're not. There is no Social Security trust fund. There is no money set aside that are invested for the payment of these future benefits. This is all strictly IOUs from the government.
Okay, and the next question. If a surviving spouse was married to her deceased husband for over 10 years, but remarries prior to age 60, does she lose her deceased husband's benefit? And does she have to be married to her current husband for at least 10 years to be entitled to this benefit?
Good question. So, and this is a follow-up question to what the person who had the corrected comment, if you will. So, if the person's remarried before age 60, that person will forfeit the survivor benefit she or he could have received from the ex-spouse. Now, if they're currently married and then the second spouse then later dies, she'll receive or he'll receive a survivor benefit on the second husband or second wife's benefit.
And the next question, can you review the note about spousal benefits before FRA? If a 64-year-old wife takes her husband's spousal benefit, she then cannot take her own benefit at 70?
If she takes a spousal benefit before her full retirement age, she's locked into that. She cannot switch to her own benefit if that own benefit would be higher at age 70. Now, If you receive a spousal benefit after your full retirement age, then you may be able to switch. You will be able to switch to your full benefit. But if you take the spousal benefit early, before your full retirement age, you're locked into that smaller benefit.
And next question, does cash withdrawn from IULs count in the IRMAA calculation of income?
Okay, a lot of acronyms there. So I'm assuming this is from a life insurance policy. If it's tax-free withdrawals, and again, I'm getting a little bit over my head. I'm not an expert in life insurance. I would certainly talk to somebody from the life insurance advanced markets, but if it's a tax-free withdrawal from a life insurance policy, that should not affect your income for purposes of calculating the Part B premium.
Okay. Can you collect spousal benefits while collecting your own benefit?
Can you collect spousal benefit while collecting your own benefit? The answer is no.
Is it possible for a spouse who is 66 to file and suspend their benefits and the younger spouse who is 62 to file a restricted application for spousal benefit when they are 66, all while allowing their benefit credits to grow and get their full benefit at age 70?
You could do both, but they both have to be at their full retirement age.
How is the 8% deferral credit computed for a person? Is it monthly or on a yearly basis?
It'll be done on a monthly basis. It'll be prorated on a monthly basis.
Okay, and we have an interesting comment here. It says, we were trained that Social Security is a, quote, intergenerational transfer tax, end quote, seeing that current workers fund current beneficiaries. So that might help with the explanation behind what Social Security really is.
Yeah, I mean, if you think about it, we're paying into Social Security for people who have retired before us. So our generation is supporting the older generation. And then when we retire, well, our kids will be paying in the system, will be supporting us. So again, there's no money set aside in this trust fund. They're not invested. It's one generation really supporting the older generation who has retired.
Next question, can you confirm the maximum number of years you can defer collecting benefits? Is 32% the max?
32% is the max, depending on your full retirement age. So it can be anywhere from 30 to 32. You cannot defer. Well, you could defer past age 70. It doesn't make any sense to do so because then you don't get any further deferral credits.
Next question, how are benefits treated with same-sex marriages and divorces?
Good question. The same. So now with the passage of DOMA, same-sex couples get the same benefits on the Social Security system as opposite-sex couples.
Does the 35 highest years of earnings for Social Security eligibility need to be continuous, or can they be irregularly spread over the working career?
They do not need to be continuous.
If my spouse takes early retirement at age 62 and I am age 63, can I collect 50% of her benefit when she turns age 67? I would then wait till age 70 to collect my Social Security.
No, because once you file for spousal benefit early before your full retirement age, you're locked into that reduced payout. You can't switch to your benefit as if you were deferred your benefit.
Can you describe in greater detail the 50% and 85% taxation of Social Security benefit above the different income thresholds? Is it a flat 50%, 85% of the amount over the respective tiers?
Good question. And the answer is not a flat amount. So the first $32,000, for instance, for a provisional income for a married couple filing jointly, there'll be no tax there, so that's zero. And then to the extent it exceeds $44,000, then the amount that exceeds that would be subject to the 85%. So the blended would be something less than 85%. Good question.
Where can we get more information on this topic since we have so many teacher clients? The Social Security website has some, but not a lot.
That's true. And Social Security will have some, not a lot. And then the Social Security Administration, some will be very helpful, some quite frankly won't be. This is why, in my opening comment, I think I made the point, it's so important that clients sit down and talk to their financial advisors first. Because oftentimes when they go to the Social Security Administration, they're not shown all the different options. And as you can tell from our conversation today, those options could be very large and dependent on a lot of different variables. And I think it's important to factor those options in. There are a couple of good books out there on Social Security. Certainly the brochure you're going to be receiving later from Brendan is going to cover a lot of things we talked about here today, which I think will give you a good foundation to start those conversations with your clients.
We have time for one last question because I'm afraid we are out of time. There is a divorced woman, 64 years old, ex-spouse is 75 years old. The woman is eligible for spousal benefit, 50% of his, assuming his is greater. Is that correct?
Divorced spouse, age 64, so she's not her full retirement age. So she is entitled to spousal benefit so long as they're married for 10 years. However, she won't receive 50%, she'll receive something less.
Okay.
At her full retirement age, she'll receive 50%.
Okay. And the follow-up question, can she defer until 70 to take her own?
The answer is yes.
All right. Outstanding. Well, this has been a tremendously informative webinar. We threw a lot of good questions at you, Brandon, and you're hard to stump. So
there were some very good questions, and by the way, some very good comments. So I really appreciate the time and the fact that so many people stayed on the call even past the hour.
Excellent. Well, thank you to our presenters, to our presenter and to our participants. I want to remind you that you're going to be receiving a series of emails, one of which will be a web link that will enable you to watch the archived presentation, and you'll also be receiving some documents, as Brandon mentioned. Thank you all for joining us today. This concludes the NAIFA webinar.